Hello and welcome. In this video, I'm going to show you a calculator that I've built that compares the different tax regimes on different investments for trusts specifically. There's another video where I compare this for individual investors. And let's see what these outcomes are. Let me share screen. As you can see, this is quite a busy Excel spreadsheet. You don't have to read all these details here. This is more for instructions to use it and also for me to explain to clients when I sit with them. In this case, I did an investment for a client for 5 million Rand, and the outcome we wanted was to see if we get a 9% return on an endowment, what similar returns must you get in other investments to get the same net result in the end here. In other words, as you can see on the right-hand side, 5396 or 5,396,000. Now, there are four different types of investments that's going to be compared here. It's interest rate in a bank account or interest, an endowment, a LISP or unit trust direct option, and a guaranteed investment plan. Now, the endowment and the LISP option has a CGT only clause here, and CGT stands for capital gains tax. And the reason I've done this is we have to stick to one certain type of portfolio in these two. Otherwise we can't properly compare them to each other. So we're going to assume that these two portfolios in this case will have equity or capital type assets in them. Right? If we use a bank account and we get 14.4% return on the 5 million, which is obviously too high in current terms. You don't get these kind of interest in a bank account in South Africa at the moment. You used to maybe in 1999, but that's a topic for another day, around about 1999, but that's a topic for another day. So 720,000 Rand return. That will be your value pre-tax before you've paid tax. Exemption, there's no exemption. I did another video on tax on individuals, and individuals get an exemption portion here, trusts don't. Then inclusion rate, in other words, inclusion rate means the total growth gets included, so 100% of this. And then the tax rate on that is this 45% here, which is the effective tax rate for trusts on interest. Anyway, and in the end, the net result will be 5,396,000 Rand. In other words, from 14.4% interest, that's the only amount that you're going to get out after tax. Right, let's go to the endowment. And this was kind of where we wanted to peg the amount to, or the return. A 9% return give you 450,000 Rand growth. A 40% inclusion rate is effective. Now, this is not something I choose. This is a legal thing. A 40% inclusion rate gets used for endowments on trusts, or endowment tax on trusts, and then a 30% tax rate applies. Why is it less than the 45% in the bank account? Well, because that's the purpose of endowments. Endowments have a lower tax rate than investing in the same or the same trust, but in a different investment type, right? 30%. Now, this 30% also gets charged and paid, or gets paid by the provider of the product, and you don't have to declare this tax. Right, let's carry on. So on the total 450, the growth that you've received, there's a total tax bill of 54,000 gets deducted, and then there's 5,396, the total outcome. You can see it's very much the same as there, but at a lower growth rate. Then the LISP, or the direct unit trust option, we can get the same return at the end, 12.37% return, growth per annum 618 in this case. An 80% inclusion rate gets used. Once again, this is not something I chose. This is a legal requirement on, or a tax requirement on trusts and the capital gains tax that they pay. And then the 45% tax gets applied to this 80% inclusion. And that's 222,660 tax. And that gives us this amount here, which is similar to those two net results. Guaranteed investment plan, the fourth investment type that we are looking at here. 5 million rand gets invested. 7.92% growth per annum. That's a growth. There's no taxes that apply here. There is taxes in the back end, but what you should remember on a guaranteed investment plan is the actual quoted return, is the actual return that you get. The provider that gives you this investment quote actually delivers that exact return to you. And it works like an endowment, but an endowment is still market related based on the return in the market, and then the taxes get applied internally. If the overlaying fund does 9%, then there's still a portion of tax inside that endowment that gets applied, and that's the net result here. So what can we learn from this? What we can learn from this is that a guaranteed investment plan and an endowment is very efficient for trusts, and a direct unit trust and interest is not as efficient. But that doesn't mean they are not bad investments for a trust, because you have to take into consideration other factors like the term of your investment. Do you need liquidity? Do you need access to money? For example, when I help clients like this, I would look at their situation. Maybe the trust is set up for someone that's disabled, and they would need access to that money every now and then for emergencies. So then obviously it won't be a good idea to invest in a type of investment that has a long-term holding where you can't access it. For example, a guaranteed investment plan has a 5-year holding, and an endowment has a 5-year holding with conditions. So then a portion of it, for example, if I feel a client needs about 2 million access, then I'll invest 2 million rand in something that's more accessible, like type 1 or type 3 type investment, and then I'll invest the rest into something more efficient in terms of returns and tax, but the client is willing to wait out the period. Right, so I hope this makes sense. If you have any questions about this, please leave a comment below the video, and I can't promise that I'll get back to everyone on this, but I'll surely try. Thanks for listening.